If you really think reporting the sale of your property is enough, no. There is another hidden calculation that is buried deep inside the US tax system that surprises thousands of Indians every year. And that hidden rule can make your tax bill much bigger than you ever expected. Well, if you recently sold an apartment or house in India that was rented out, even for a short period of time, you may have unknowingly stepped into one of the most complicated tax traps under the US law. And surprisingly, this has nothing to do with the selling price. That's right, it is about how the IRS calculates the value of your property before it even looks at your capital gain. Most people use a very simple formula here. They convert the purchase price into US dollar, convert the sale price into the US dollar, subtract one from another and believe that they have calculated their taxable gain correctly. If tax has already been deducted in India, they assume that foreign tax credit will solve the remaining problem. Ladies and gentlemen, unfortunately, the IRS looks at the transaction very differently. Under the US tax rule, once your Indian property starts earning rental income, it is treated as depreciable foreign real estate. So that means the IRS assumes that the building loses value every year for tax purpose. And here's the most surprising part. Even if you ever claim depreciation on your US tax return, the IRS can still reduce your property's cost basis by the amount of depreciation you were allowed to claim. So, you know what this means? This means that when you finally sell the property, your taxable gain, it may be much higher than you expected. What looks like a relatively small profit on paper can become a significantly larger taxable gain after the IRS adjusts the property's value using its own depreciation rule. Well, a portion of that gain, it may even be taxed under special depreciation recapture rule instead of the normal long-term capital gain rates. Well, the calculation, it becomes even more complicated. You know why? Because exchange rates also matter. The purchase price, annual depreciation and final sale proceeds, it may all have to calculated using different US dollar exchange rate depending on the timing of each transaction here. As a result, even if your profit in Indian rupee, it appears modest, your taxable gain in US dollar can be much higher. And that is exactly why thousands of Indians in the US make reporting mistakes during property sales. They believe they have calculated everything correctly, only to discover later on that IRS uses an entirely different method. Reviewing these calculations before filing your return can help avoid unexpected tax bills, interest, and compliance issue in near future.